Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course to make it actionable, understandable, and clear. What a week. What a show. We've put together a great one for you. We're going to be looking at 3 items. The first being, boy, are there a lot of warnings for a market crash. We're going to look at Mr. Jamie Dimon. We might contrast him with Mr. Howard Marks. We shall see. We then are going to look at Mr. Jason Zweig, one of our favorites, warning us about fees. Warning us. This article is a little complicated, but I think my intelligent listener base can handle it. And then in closing, we've got fascinating data about the stock market returns by Mr. Peter Mallouk. A friend of the show sent us in an excellent graphic comparing the U.S. median house price and S&P 500 from 1970 to present. I'll let you guess who the winner was there. And then I give a little worst case scenario talk. For those who are convinced the crash is coming, as Mr. Jamie Dimon is, we do a little worst case scenario talk and see if that doesn't come for you. But at the top, Mr. Dimon. This is in The Guardian. Simon Goodley writes this. Head of largest U.S. bank warns of risk of American stock market crash. This is a British news syndication. Subheadline, Jamie Dimon, chair of JP Morgan Chase, said he was far more worried than others. Ooh, about serious market correction. Did you hear that, listener? Jamie Dimon is far more worried than others. What do you think Mr. Dimon's trying to communicate to us when he says he's far more worried than others? Do you think he's trying to sound less intelligent or more intelligent? Well, if he's like me, he wants to sound more intelligent. And in the investing world, you sound more intelligent when you predict a bear market, the market going down. He sees it, we don't. Luddites that we are, we're just hammer, nail, index fund all the way. He's far more worried than others. Here's what he says. He thinks a market correction he predicted could come in the next 6 months to 2 years. Okay, so he's given himself some pretty wide berth there. He's basically saying the next 2 years. He doesn't define correction. He says, I would give it a higher probability than I think is probably priced in the market and by others, he told the BBC. So if the market's pricing in 10%, I would say is more like 30%. Dimon added there were a lot of things out there creating an atmosphere of uncertainty, pointing to risk, including the geopolitical environment, fiscal spending, and the remilitarization of the world. Are you scared yet, listener? Mr. Dimon says all these things cause a lot of issues that we don't know how to answer, he said. So I say the level of uncertainty should be higher in most people's minds than what I would call normal. And there's more, listener. On Wednesday, the head of the International Monetary Fund, Kristalina Georgieva, said the world economy has shown surprising resilience in the face of Donald Trump's trade war. But here we go. Here's the warning. Buckle up. Uncertainty is the new normal. She's quoted, this Kristalina, before anyone heaves a big sigh of relief, please hear this. Global resilience has not yet been fully tested, and there are worrying signs that test may come, she told Noddings, the Milken Institute in Washington. Do you hear that? The Milken Institute in Washington. How smart can it be? Oh, the Bank of England has concerns. There's growing risk of a sudden correction in global markets. Stock market bubble. Jamie Dimon says that a bunch of money in AI will be lost. So, listener, did you catch a pattern or a theme in the quotes that I read for you? These folks are saying bad things are going to happen. There's an old phrase that says, bears sound smart, but bulls make money. Now, yours truly, I'm what's called a permabull. I don't even think about the market going up or down because I'm so bad at it. I found myself, I not only have I never market timed correctly, but I've never met anyone who's market timed correctly consistently. And I'm paraphrasing Warren Buffett here, where he says he's never met anyone who's market timed correctly, and he's never met anyone who's market timed correctly. Because amidst all these warnings, you know what this is? This is market timing. This is a sermon on market timing. If you think in the next 6 months to 2 years there will be a significant correction, I bet you want to hold more cash. I bet you want to hold more bonds. You know what the problem is, listener? And I've done a Jamie Dimon kind of expose previously. Jamie Dimon's been saying this forever. He has been saying, here comes the crash. I want to say for at least a decade. It just, this is the latest one that we're reading, but I'm telling you guys, if you want to go back, you want to do a little project, if your kids ask you, hey, you know how they said it was supposed to be, Mr. Dimon told us, hey, there's these dangers, and has he always done this, or is this new? The answer is, he's always done this. He's been saying, this is August 9th, 2024. Jamie Dimon sees a 65% chance of recession. May of 2022, Jamie Dimon sounds the alarm. This looks good. The worst is not over, says Jamie Dimon. This is earlier this year. He still sees a U.S. recession. Oh, so you see that, listener? You see what's happening? It sounds like it's just a broken record. So he's a very smart man, does a great job. He should not be informing your investment decision-making. And that's one of the difficult problems as an investor. You look at these luminaries, you say, oh, these people. But wouldn't you know it? I read a counter position, Mr. Howard Marks, who's Mr. Deep Value Investor, very famous, very wealthy. He does the opposite. Howard Marks at Oaktree. This is CNBC. The valuations are high but not crazy. And he says this, expensive and going down tomorrow are not synonymous. So this is the same week. He does not see a bubble. He does not see psychological excess. I then did a little research myself. I was talking to someone about, is there a bubble or not? And I said, well, what do you think the forward price to earnings ratio of NVIDIA is? The NVIDIA being the largest market cap company, the big GPU maker, AI frenzy, yada, yada, yada. Forward price to earnings is they take an average of analyst future earnings expectations and come up with that figure. What do you think it is? Well, if you speak Dachshund, you know that guess was incorrect. Fern came in with a guess at about 60. NVIDIA's forward PE ratio is about 31. It's an estimate, analyst estimate. What do you think Walmart's is? If you guessed 40, you'd be correct. So whenever people tell you, hey, there's a bubble, watch out for these AI stocks, sometimes you just got to say the research shows that, hey, Walmart's at a 40. That's Walmart. Walmart's at a 40. And NVIDIA is coming in at a 31. So not everything that sounds expensive is expensive. Up next, now that you're not as scared as market crashes, I hope, Mr. Jason Zweig, our man downtown, one of our North Stars here, he's got an article. October 10th came out, headline, Congress thinks hiding fund fees is good for you. Whoa. That's a gotcha. That's a clickbait. Okay, I'm clicking on that. Subheadline, even if fund expenses seem to disappear, they're still the biggest drag on your returns. Now, this is an interesting article that requires a little bit of definitional work. This is not one of Zweig's hammer nail articles. He's actually dealing with a type of company called a BDC. Business Development Company. And I don't deal a lot with BDCs. I don't pick individual stocks, so I really don't deal a lot with them. But these BDCs, I did a little research for you, the listener. They are typically lenders or investors in these middle market companies that are private, and they distribute over 90% of their earnings the way a REIT would, and there's a really big yield. So one of the largest is Ares. They have a BDC. It's like a 10% yield. There's another one that is close to 12% yield or so. But I looked in and I said, these BDCs, they're tickers like any other company. They're tickers. What are the fees? Well, it's about 1.5% a year plus a performance fee. So it's similar to a private equity style fee, but the disclosures, Mr. Zwig is right in saying this, not simple. And what BDCs used to have to do is disclose the way an expense ratio is forced to disclose. They would say clearly what the cost would be. So, and some of these costs can be very high on these BDCs, very high. He estimates annual expenses that can range from 3 to 18%. Some of that has to do with, of course, the performance fee and how much is remitted back to the parent company. These BDCs are sending the fees up to the parent company, so you don't always see it. Now, the lesson I learned from all this is there are 1,000 different ways they can charge a fee to you. And if you don't know what the fee is, it's higher than you think. So I would stay away from BDCs. The yield is just beautifully high. And temptation, it's Garden of Eden type temptation to, a 12% yield. Don't do it. Don't do it. It's very risky. In 2009, a lot of these BDCs got smoked out. What I think Mr. Zwig is saying here, and there is legislation, pending legislation. It's a single paragraph. Zwig says there's a standardized table of fees and prospectuses that would be changed. It would no longer have to include expenses of a BDC that it invests in. I think Mr. Zwig, I like where he heads. He wants more transparency. In this instance, I would prefer more disclosure. I don't think it's as bad as the headline suggests. I think it's possible that Congress is trying to streamline and standardize the type of fee reporting. Now, you and I both know we don't want anything to do with high fees. Doesn't matter if John the Baptist himself is pitching the fund or not going to get near it. So, but with these BDCs, I learned this in just researching. I didn't realize how high the fees were. High. The merit of this article can be in the general themes Zwig points out, which is that, hey, high fees are really bad. He gives a great example. He says, let's assume a portfolio of stocks returns an average of 8% annually. If you invest $10,000 and you'll have more than $100,000 after 30 years. If you incur 1% annual fees, though, you'll end up with $76,000, so 1/4 less. So his lesson to you and me is, no wonder it's called a 1% annual fee. That sounds better than 1/4 of your wealth fee. Did you get that? The fees compound, and ultimately it's a real losing proposition for you. He says fee blindness is a plague that never goes away. And he's written all these articles about these terrible, terrible funds. Well, wouldn't you know it? As long as you're going the right direction, listen to the market update, the cost of investing is basically zero. But most investors, and I agree with this, Zwig says this, they simply don't know or care about the fees they pay. That's the problem. That's why, when in doubt, lean towards disclosure. I think Zwig's right. They should lean towards disclosure with these BDCs. I don't think it's as bad as he's saying it is, but they should be more transparent. And then in closing, we've got fun data. Peter Mallouk, one of our favorites, $1 in 1870. After inflation grows to how much money? Bring the children in for this one. It's $33,000. $1 in stocks grows to $33,000. And wouldn't you know it, there are a jillion problems from 1870 to present. You may know them already, but I'll read a few. There was a depression and railroad strikes of 1890. The Baring Brothers crisis, don't know about that one. There's the cornering of Northern Pacific, the outbreak of the Boer War, the rich man's panic. I don't know that one. The Panic of 1907. I guess that was not the rich man's panic. The enforcement of the Sherman Act. World War I and influenza. And then here we go, 1929. Great Depression, post-war bear market, Vietnam, Watergate, Cold War, Cuban Missile Crisis, inflation, Black Monday, the lost decade, COVID-19, Ukraine, inflation, and all of a sudden $1 from 1870 got you to 33 grand. Now you rightly say, now Robert, that's multiple lifetimes. How do you expect me to have that sort of vision? Well, you're going to live, so you might as well try. You're not promised tomorrow, but you might as well try. The lesson here is don't be a gambler, don't be a speculator. Be willing to have a long-term view. And then if a friend of the show sends this over, grateful for them. They show 1970 to present, the long-term performance of stocks and housing. It shows housing going up a little under 2x, maybe 1.7x, and the S&P 500 up 7x, so 7 times. Just another reminder, housing provides great utility, wonderful place to host friends and family, not a great investment relative to the other options you have. And then in closing, if you ever get down and out with Mr. Diamond and his prognostics that we're heading for a dip, a big dip, let's head back to the biggest dip, 1929 peak to 1933 trough. And I want to go to dividend payments. And it drops. It drops. As you'll recall, the market went down 90% top to bottom over you guessed it, about a little over 3-year period. Well, what happened to dividends? They got cut in half, basically, a little more than that. At the peak, the U.S. market was paying out about $5.9 billion. At the trough in 1933, it paid out $2.6 billion. So you would have over 50% haircut in your income if you were just looking at that. But not as bad. Not as bad. Not great, but not as bad. And then it slowly marched back up into the 1940s, and you got back to where you were, and then it just kept pushing from there. But the reminder I saw was, as bad as that was, and it was bad, companies kept paying dividends. Not all of them. You're down, it's dramatic. You're down 50%, over 50%, but you climb back out of it if you had the ability to hang on. So it's resilience. It's resilience that matters the most in the investing game, not optimization. Don't let anyone tell you otherwise. A lot of times we get lost in do I do this investment, that investment? Do I do the Roth or the regular? What's the plan you can stick with for 80 years? That's your answer. And oftentimes we don't know that. But not a bad way to start is just to remember to keep those costs low, that investing simple, and that time horizon long, because that is what's going to give you the best shot on your investing journey. Until next week.